Two men started with the exact same amount of money. 20 years later, one of them owned 11 properties. The other had never bought a single piece of real estate in his life. And yet, when we finally sat down and added up both of their net worths, the numbers were almost identical. If that surprises you, stay until the end, because the reason why is going to change the way you think about building wealth for the rest of your life. Let's call them Alex and Chris. Both started in their mid-20s with roughly the same income, the same student debt, and the same nagging feeling that they were behind. Both wanted the same thing, financial freedom, but they chose two completely different roads to get there. And for 20 years, they never looked back. Alex went all in on real estate. Chris went all in on index funds. And today, we're going to walk through exactly what those 20 years looked like for each of them. The wins, the stress, the sleepless nights, and the quiet, unremarkable months where nothing seemed to be happening at all. Because that's the part nobody shows you. Everyone loves to talk about the payoff. Almost nobody talks about the boring middle. Let's start with what index investing actually asks of you, because it's simpler than most people think. It doesn't depend on finding the perfect property, timing the market just right, or negotiating the best possible deal on a building. It doesn't require managing tenants, fixing broken water heaters at midnight, or chasing down late rent payments. It simply asks one thing of you: time. Give it time. Stay consistent, and let the market do the heavy lifting in the background while you go on living your life. So what should someone actually choose? The honest answer is that it depends less on spreadsheets and more on who you are. If you enjoy hands-on investing, if you like solving problems, negotiating deals, and slowly building a portfolio of properties you can see and touch, then real estate may be an excellent fit for you. There's a certain satisfaction in walking past a building and knowing you own it, in watching a rundown unit transform into something tenants are proud to call home. On the other hand, if you value simplicity, flexibility, and the freedom to invest from a laptop anywhere in the world without a single phone call about a leaking roof, index funds are incredibly difficult to beat. They ask almost nothing of your time and almost everything of your patience. That trade-off is the whole story in a single sentence, and it's worth pausing on. Time versus patience. Involvement versus distance. Two completely different personalities can both win as long as they pick the path that actually fits who they are. And for many successful investors, the answer isn't choosing one over the other, it's combining both. A diversified investment portfolio paired with carefully selected real estate can provide growth, cash flow, and balance all at the same time. The stock market gives you liquidity and broad exposure to the entire economy, while real estate gives you leverage, tangible ownership, and a hedge against certain kinds of inflation. Neither one has to carry the full weight of your financial future alone, because the goal was never to prove that one investment is perfect. The goal is to build wealth that lasts, wealth that can survive market downturns, personal emergencies, and the inevitable surprises life throws at every investor sooner or later. And the final lesson that Alex and Chris learned over the course of their 20 years journeys may be the most valuable one of all. So, after 20 years, who actually made the better choice? The truth is, both Alex and Chris succeeded, not because they found the perfect investment, not because they timed some magical entry point, but because they committed to a plan and stayed with it through years that were boring, years that were stressful, and years that tested their patience in very different ways. Let's look at what that actually looked like day to day, because the headline numbers only tell half the story. Alex accepted a certain kind of responsibility. He managed repairs when things broke. He handled unexpected expenses that showed up without warning, the kind that never seemed to arrive at a convenient time. He dealt with tenants, with paperwork, with the everyday ups and downs of owning real estate, from vacancy periods to maintenance calls to the occasional difficult conversation. There were months where a single busted furnace wiped out 3 months of profit in one afternoon. There were tenants who paid late, tenants who left the place a mess, and at least one 3 a.m. phone call about a burst pipe that Alex still brings up at dinner parties. In return for shouldering all of that, he built equity month after month. He generated steady rental income, and he came to own a valuable, tangible asset that continued to appreciate over time. His path required more effort, more attention, and more direct involvement, but it rewarded him with something he could point to, walk through, and hand down. There's a version of wealth that lives on a screen, and there's a version you can stand inside of. Alex chose the version with a front door. Chris accepted something different. He ignored the daily market noise, the constant stream of headlines predicting the next crash or the next boom. He resisted the temptation to chase hot stocks or jump on whatever trend was dominating financial news that week, and there were plenty of tempting ones over 20 years. He invested month after month, quietly and automatically, even when the market looked uncertain, even when friends were telling him to pull out or to bet big on something flashy. Instead of relying on leverage the way Alex did, he relied on discipline. He trusted the process, even when it felt like nothing was happening. And for long stretches, nothing visibly did. There were years where his portfolio barely moved, years where it felt almost embarrassing to tell people what he was doing with his money, because "I bought index funds again this month" doesn't exactly make for exciting conversation. And over time, compounding quietly, almost invisibly, turned his small, consistent investments into substantial wealth. His path required less daily effort, but it demanded a different kind of strength, the patience to stay the course when nothing exciting seemed to be happening at all. That's a harder skill than it sounds. Doing nothing on purpose for 20 straight years, while the world constantly tells you to do something, is its own kind of discipline. That's the lesson most people miss entirely. People spend months, sometimes years, arguing about whether real estate is better than stocks, debating cap rates versus expense ratios, comparing cash-on-cash returns to historical index performance. But very few of those same people spend those months actually investing. They stay on the sidelines waiting for certainty that never arrives, while their potential returns quietly slip away with every month of inaction. The biggest risk isn't choosing the wrong investment, it's waiting for the perfect opportunity that never actually arrives. Because while you're waiting, weighing every option, reading every article, and searching for the one strategy with no downside, time keeps moving forward regardless. And time is the most valuable asset any investor has, far more valuable than any single stock pick or property deal. The earlier you start, the more opportunities your money has to grow, to recover from dips, and to benefit from decades of compounding. The longer you stay invested, the more powerful that compounding becomes, often in ways that feel almost unremarkable year to year, but become extraordinary when viewed across decades. 10 years in, Chris's portfolio looked modest. 15 years in, it looked respectable. It wasn't until year 18 or 19 that the curve finally bent upward in a way that made people stop and ask what he'd been doing differently. The answer was nothing differently, just longer. Whether you choose rental properties, low-cost index funds, or some thoughtful combination of both, your success will depend far more on consistency than on finding some magical strategy that guarantees outsized returns with no risk. There will always be scary headlines warning of the next downturn. There will always be market crashes that make people question everything they believed about investing. There will always be people online or in your social circle claiming they've discovered the next guaranteed path to riches, some shortcut that bypasses the slow, steady work that actually builds wealth. Ignore that noise as best you can. Focus instead on the fundamentals. Invest within your means without stretching so far that a single bad month puts your finances at risk. Keep learning about the assets you own and the markets you're participating in, not so you can chase every new trend, but so you can make informed decisions when it actually matters. Stay patient even when patience feels unrewarding in the short term. And let time become your greatest financial partner, quietly working in the background of your life whether you're paying close attention to it or not. Because in the end, wealth isn't built by making one brilliant decision, one perfectly timed trade, or one incredible property deal that changes everything overnight. It's built by making hundreds of good decisions and repeating them year after year, even when they feel small and unremarkable in the moment. It's the boring, repeated actions, the automatic contribution, the on-time mortgage payment, the reinvested dividend that add up to something extraordinary over enough time. Neither Alex nor Chris got there by being clever. They got there by being consistent. for longer than most people are willing to be. That's the part the headlines never mention, because he kept doing the same thing for 2 decades doesn't make for much of a story, but it's the only story that actually works. So before you make your next investment, ask yourself one simple question. Am I chasing excitement or am I building a future? The answer to that question may have a bigger impact on your financial life than any single stock, property, or investment you'll ever buy. Excitement fades quickly, and the thrill of a hot tip or a trendy asset rarely survives contact with reality. But a future built brick by brick, contribution by contribution, decision by decision, tends to hold up long after the excitement of any single choice has been forgotten. Alex still owns his properties. Chris still holds his index funds. Neither one is richer in any way that matters. What they both have 20 years later is something most people never get around to building at all. Proof that showing up month after month is the entire game. If you enjoyed this comparison and want to see more real-world money breakdowns backed by numbers instead of hype, make sure to subscribe. Because in the next video, we'll answer another question that could completely change the way you think about building wealth. Is it actually smarter to pay off your mortgage early or to invest that money instead? The math might surprise you, and the answer may not be as obvious as either side of that debate usually claims.